Hello everyone, and welcome to the second in GreenKite series of webinars focused on resilience for insurance firms in the 2020s. And our first webinar was a wide-ranging discussion looking at the real-world to-do list for London market and MGA practitioners, and it took us well beyond the business continuity plan. Today, we're focusing in on ESG, environmental, social, and governance issues, broadly defined, I think, as an approach that measures the effect companies have on the environment, their customer and society, and as well as on their own people, actually. So it's well established in the investment world, and it's fast mainstreaming as a key board agenda item for firms, all firms actually, but especially and including insurance. And it's an absolutely enormous field. But today we want to zero in on the data angles, and especially in the context of recent developments from Lloyds of London. So hello, I'm Sian. For those of you who don't know me, I'm a founding associate of GreenKite, and in the interest of full disclosure, wearing different hats to the ones I wear for GreenKite, I've spent the past 2 years or so making it my business to become as informed and opinionated on ESG and its relationship to and with insurance as I possibly could, which is how I came to know our two ESG expert guest panelists, Martina McPherson. Martina, do you want to wave? I don't know if people can see you actually at the moment, because I think we've got the holding screen up, but you'll see Martina shortly, and Charles of Ethics Grade. Hi, Charles. So what we want to do today is to unpack how insurance colleagues can actively make sense of ESG as a data and business resilience challenge and opportunity. And to help us do that, our panelists are joined by two insurance experts, as I've mentioned, Karen Stanford and Peter Killian. So as I've said, we really do want your questions, and I do intend to keep us quite tightly to time. But the other thing to say at this point is that we're aiming to avoid the use of all acronyms, excluding ESG, obviously, for obvious reasons. And I've asked Gemma to make sure that if any of us inadvertently use an acronym, she shouts acronym to make us step back and make sure we define it at least. Okay, Gemma, do you want to open up the screen so our guests can be seen? Okay, so panelists, then let's kick off. And as I've asked you to share who you are, what you do in your day job, and to summarize in a very short space of time, just the top level items that you think colleagues today should be thinking about or wanting to ask questions about. If you're operating in financial services, what are the things around ESG that you shouldn't be worried about being ignorant about, but you should be working on filling those knowledge gaps? So Martina, if I can come to you first, please.
With great pleasure, Sian. My name is Martina McPherson. Yes, I am at Otto BHF Asset Management and Private Equity. I'm a member of the General Management Committee for the Asset Management and Private Equity teams. But in my day job, I'm also heading the ESG strategy topic and division, which means together with my team, we look at ESG research, analyses, ratings and scoring models, data inputs, as well as active ownership. And in alignment with this and with the investment teams, we are also defining the product roadmap that we are actually looking for when talking about ESG approaches. May they be linked to screening, may they be linked to integration. And again, I highlighted the active ownership, engagement and dialogue component. To give you a bit of an idea, we cover in our research around 1,000 different entities in the SME space, which is quite a space that has inherent data challenges. We're covering the European universe on our own. And beyond that, of course, we look at multiple thousand companies using MSCI's ESG research for global universes. And apart from MSCI, we also look at different inputs, for instance, CDP for environmental criteria. And we're currently building and expanding this particular universe and the approach for assessments by also building an IT-based ESG data and services management system. And most excitingly, I'm currently playing around with the capabilities of AI, fintech, and screening in this context. And we hopefully might elaborate on some of these topics during today's discussions. You asked
okay,
me,
thank you.
So
yeah, just I guess the one of the questions from your point of view then would be that our audience and others should be asking is, do you know enough about the data ecosystem and how can you find out about it? Would that be fair, Martina? as
Data
a question?
ecosystem, absolutely. Understanding the market, the sentiment and the trends. And maybe as a third aspect, Sean, the preparedness around the implications of regulation in our sphere, because regulation takes an ever increasing layer of complexity, or brings an ever increasing layer of complexity, but hopefully also more clarity, comparability and consistency of ESG data and information, which is, as you highlighted, a challenge.
Brilliant, thank you. And we'll certainly want to go into those issues a little bit further down in the conversation. Peter, if I can ask you, who are you, what do you do, and what are the questions, Peter, for you, top line?
Thanks very much, Sean. So I'm Peter, and today I'm participating in my role as a Lloyds ESG Advisory Group member. And the Lloyds ESG Advisory Group was set up in Q4 2020, around the time that the Lloyds ESG report was published. The advisory group is comprised of both insurance and non-insurance representatives, and practitioners from managing agent firms, including myself, have joined the group to help Lloyds to come up with ESG principles, as Lloyds realise that the devil is in the detail here. I'm there specifically to bring a practitioner viewpoint and hold Lloyds to account and represent the market. I have a background as an underwriter, and so that's what I'm particularly interested in. What does this mean for people who do the underwriting role, and what do they need to do differently? So that's what I'm hoping to uncover today is, what are those data points that we need to be capturing? What do those underwriters need to do in their process in order to ensure that they're doing that?
Fantastic, thank you very much. Charles, coming to you, the same, please.
Thank you, Sean, and yeah, just a big thanks to the team at GreenKite for putting this session together. It's such an important topic, and such an important time, I think, to be looking at it. So hi everyone, I'm Charles Radcliffe. I'm one of the founders at Ethics Grade. We're a fintech startup focusing on ESG ratings and trying to disrupt the rating space. We've chosen quite deliberately to look at a niche of ESG, a niche that no one else is looking at. And that niche is technology governance, and particularly AI and AI ethics. And the reason we've chosen this niche is because the founding team, myself included, have a background in this space. I was formerly the head of AI at Fidelity, and previously head of technology at Deutsche Bank's innovation function. And then before that, I used to run a data analytics company. So back in the days when Mark Zuckerberg was the Time Person of the Year and saluted as being the hero of the tech world, people like me were critical and concerned, and I guess we've had our concerns validated over the last couple of years. Cambridge Analytica was really the kind of hole in the ozone layer moment for my field in ESG. So a lot of what I do is look at what other people have been doing in other aspects of ESG, like in climate change, and try to emulate and replicate their approach so that we can start to build data on an area that there's a huge amount of demand for data around, which is the quality of governance on AI. In my day job, I look at the good and the bad and the ugly, but most of it is ugly, I'm afraid. Trying to understand, why it is that companies have made mistakes, why it is that things have gone wrong. And I guess unlike, other people in this community, like journalists and media who will often write about, why things have gone wrong, what we're looking for is essentially a quantitative analysis, and looking for evidence of governance that's missing, and ideally looking for evidence of governance that's in existence in other organizations. So I guess I'm somebody who can talk about what operational controls organizations need. And I guess what's interesting about the insurance industry is that not only is it you need to understand the risks in terms of the counterparties that you're doing business with, but also understanding your own set of risks as well. So really fascinating to be here, and I'm probably going to learn as much from the other panelists as I'm going to contribute. So yeah,
that's the whole idea, Charles, right? That is the whole idea, that everybody's learning from everybody, genuinely. And thank you so much. And there's definitely some areas there that we're going to dig into a little bit further in the conversation. So lastly, Karen, my fellow co-founder at GreenKite.
Hi everyone, my name is Karen Stanford. I'm Operations and Transformation Lead at GreenKite, with expertise in operations and change. And ultimately, that's where ESG needs to come from. It needs to grow organically within the organisation. It needs to be a strategy to deliver. And we need to make sure it is on the board agendas, exec agendas, and everybody at the bottom, because we've got to do a top-down and a ground-up approach to making this happen within our industry. I think insurance is a really interesting place to look at this because we are risk takers and we're risk assessors, and ESG is all about managing a wide range of risks. And if you look at most firms' risk registers, ESG risks will be on the top, but they're very, very hard to resolve, and they're very, very hard to measure, I think, the performance. And I think that's one of the biggest challenges. I'm quite lucky that I had the privilege of working for Flood Re previously, which was founded on very much a social purpose to kind of increase kind of accessibility and availability to those at high risk, also alongside the climate change. So I've worked in an organisation where ESG is very much at the heart of everything that they do. However, when you flip into other insurance companies, everybody's at a different stage of their journey. So it's how you make a positive step towards the right direction. I think the things we need to think about with regards to ESG in the organisations are kind of, how do we want to approach that? What are our kind of top priorities? How do our corporate values kind of align to the ESG principles? Because you can't do all of it all at once because there's so much to cover. And it's really about thinking about where firms can make individual contributions and where they want to focus their challenges. And I think that's a really interesting place to be.
Great, thank you very much, Karen. And now, you know, listening to this and listening to the four of you, panelists, please don't freak too badly, but I'm going to slightly change what we only slightly in terms of the order. Okay, so what I really think would be useful at this point would be for Peter and Karen, as the insurance experts and the non-ESG experts, to really unpack a bit further the issues and questions that you've both talked about are at the forefront when you're trying to make sense yourselves of what ESG could and should mean in insurance. And then we can get Charles and Martina to kind of give us some thoughts about where they would start, where they would go, the kinds of questions or responses that they would be having in response to the operational, the process, the data choices, the kinds of things that come out from you. And also just quickly flicking over to the questions. Thank you to James and Amal for asking questions. Just going to throw these in and we can pick them up as we see fit during this conversation. So James is asking a question, for smaller businesses, SMEs, what are the most relevant ESG metrics to use? For example, where public commitments to being carbon neutral and the like aren't available. And I think that whole issue, by the way, of how and when and why and how relevant and how accessible ESG metrics and processes really are to SMEs. And we can come to you, Martina, in the conversation on that perhaps. And then for Amal, I hope I'm saying your name correctly, for the economies that are fossil fuel driven, like Saudi Arabia, UAE, etc., what are the ESG metrics the insurance industry can or should adopt now and over the next 5 years, goodness me, to help business and societies to benefit from net zero? So I think there's a question there about the practicalities of insurance interacting with customers, particularly in those areas where fossil extraction, where we know there are going to be some ESG issues. But Peter, coming to you first, that to-do list, that to know about list, talk to us about that in some more detail.
So as I mentioned in the intro, and you know everyone on this call will be familiar with, Lloyds published that ESG report in December, and it sets out how Lloyds is aligning with the UN Sustainable Development Goals and how it is in support of the principles in the Paris Agreement. But it's the first time that Lloyds has set targets for responsible underwriting and investment to accelerate this transition from, you know, our reliance on fossil fuel towards renewable energy sources. And so, you know, as we know, Lloyds will start to phase out insurance cover for investments in thermal coal-fired power plants, thermal coal mines, oil sands, and new Arctic energy exploration. But the market is understandably, you know, those 50 carriers that make up the Lloyds market are taking action. You know, we've only had 1 quarter into this year. That report was published right at the end of last year. But there's a sentiment that it's easy to get carried away with how much information is out there. Related to ESG, you know, there's a lot. It feels overwhelming at times. There's a sense that we are currently in a bit in the dark on this topic because we are a bit later coming to it. And the guidance at this stage is very broad and perhaps open to interpretation. What is reassuring is to know that Lloyds, in conjunction with the Lloyds Market Association, who's the trade body which represents underwriters in the Lloyds market, will be publishing further guidance in June. So that's just around the corner now, which will start to make it clearer as to like what those managing agents and insurers need to do. And they're developing a framework to help insurance business to integrate ESG principles into their business activities. But right now, there's this sort of grey area in between where people are starting to set up working groups in their organizations. There's a big risk management focus because, as Karen mentioned, it's the top of risk registers. But what is the detail that goes into that? Because there isn't a lot of information out there for, I suppose, the underwriting elements specifically, because investments obviously had a lot more lead time on this. So I suppose for me, it's like, what can we learn from people who've done this already on the investment side? Martina mentioned those data providers, but clearly there's not going to be this one size fits all, and there's going to be an element of trial and error with this.
Okay, that's great. Thank you so much, Peter. Really good. So Martina and Charles, let's talk about the data ecosystem and the choices, and this notion that maybe there's one supplier, one index, one metric out there that will solve all the problems, one dashboard that can be created. But equally, looking at processes and the ways of thinking your way through this operationally, both of you will have views on, think like this. These are maybe some of the pitfalls that you would be highlighting to our audiences today to avoid around the kinds of issues, the general issues around data and making choices and really starting to bridge the knowledge gap internally. What would you be recommending or sharing? Martina, let me come to you first. Take your pick of any of those issues and feedback where you want to.
Sure. I mean, one of the first issues is absolutely correctly stated here. SME companies, obviously, disclosure remains scarce. If we are looking into the larger cap and listed universe, generally it's a fair thing to say corporate sustainability reporting, may that be as part of an integrated or a standalone report, has really taken off and it increased exponentially over the last few years. That's been mainly driven by regulatory changes and the EU NFRD, for instance, the Non-Financial Disclosure Directive. It's been driven by investor demand. It's been driven by peer group pressure and also by coalitions and memberships and working groups who literally focus more on ESG disclosures, frameworks, data, and ultimately calls and sets the mandate for the harmonization of these, for more clarity, consistency, and comparability of information. But ultimately, the non-listed space, but even the listed SME space, also because it falls not necessarily under the prerequisites of the current non-financial disclosure regulation, in this particular segment or in this particular area across sectors, information remains scarce. And that means ultimately, as some of the ways to get information is to either work with data providers that have a specific focus on the SME universe or even on the non-listed space. There's, for instance, RepRisk and Apex out there that actually assess this particular area. In the private equity domain, there's also Preqin and a variety of other niche providers that have specifically made it their mission to focus on these hard to get by type of universes. Beyond that, and this is exactly one size does not fit all, in order to close some of the conundrums and gaps, increasingly asset managers are undertaking their own efforts to either aggregate information, take different inputs from different providers and create their own scoring methodology. That's what we are currently doing. And they also conduct their own research and engagement to actually get access to additional pieces and layers of information from companies. That's also what we are doing. And in turn, this actually leads me to the second part of this particular question. Of course, you cannot put the same type of level of information quantity and outputs on the type of information you're getting from large cap listed companies that are mandated by regulation, by research and rating houses, by investors for some time. And of course, listing requirements here at stock exchanges play a role as well, right? For some time to display this information or ESG information. You cannot compare apples with pears here with the SME space per se, but you can set as an investor, as as someone working in the liabilities management sphere, and I count obviously insurance companies to this as well, you can set and predefine a framework of ESG data and information / metrics that you're aiming to get more information on, either from companies directly through your own research, and again, we hopefully discuss it a bit later, through the implications and facilities that fintech screening and AI-based screening can provide.
You mean those technologies actually aiming, helping rather, to be able to analyze and aggregate massive amounts of information at speed? Yeah. Okay, Martina. Thank you so much.
Right. But it's mainly, again, it's mainly applied at the moment for when and where listed universes are concerned, because again, you can only, of course, capture what's been disclosed in the first place. So again, I think for the SME space, there are limitations to this as well.
Okay, thank you. Charles, going back to one aspect of Peter's question, which was, there's, as I hear it, my words, Peter, there's a slight limbo space at the moment. I mean, and that's working on the basis of what comes out in June from Lloyds with regard to this specific set of policies. The first time, as Peter said, that responsible underwriting as a phrase has appeared, actually, Peter, to my knowledge, but also targets set against it. That advice coming out in June will be specific and granular enough and practical enough at this point to actually close what seems to be a sort of a bit of a limbo between, we know it's coming, we know it's important, we're getting more familiar with it because we feel like it's coming at us from every angle, every hour of the day, between, yeah, but what do we actually do ourselves? How can we really start to grasp this as a set of data challenges? Maybe it's not just data challenges. You might have a view on that as well, Charles. I mean, what would you be saying as ethics grade? You know, your business, as you've explained, is trying to make people see, understand and grasp AI specific issues. But do you want to share what your thoughts would be for those guys and gals listening in, saying, yeah, but what do I do next? What do I think next? What should I be working on now?
Sure. So I think just take a step back and say, when we're talking about ESG, really we're talking about, I think in a very expansive sense, we're talking about alignment to values, and the whole purpose of why we're communicating or disclosing or reporting against ESG measures is because we're trying to hold out that we're trustworthy as an organization, and we're trying to be able to communicate in such a way that people can decide whether we are trustworthy according to the things that they care about. To the question on, I think it was James's question on the chat about what smaller businesses need to do. I think it's quite interesting. You know, a lot of us in the ESG space, you know, think there's probably a disadvantage that small businesses might have in terms of what they need to do around ESG. But I think there's a huge advantage that small businesses have, because essentially to be able to communicate with your stakeholders, to be able to engage with your stakeholders and really understand what your stakeholders care about is something which is much easier as a small organization than it is if you're a large firm like, you know, Facebook with, you know, nearly 3 billion users. And so really I think the ultimate goal is to ensure that you've thought through and you've communicated and you've brought on board that stakeholder feedback. And I think that's, to me, the starting point. Forgetting what is mandated in reporting requirements or what's, you know, coming down the pipe in the next report. I think, you know, the starting point needs to be, how do we as an organization understand what values we have? And the first group of stakeholders are fellow colleagues and fellow employees. And the second most important stakeholder group is customer base, and understand what values are important to them. And of course, those values are quite diverse in breadth, you know, climate change, pollution, human rights, diversity, you know, there's people like me talking about AI ethics, which is like a super niche. So the really important thing is, you know, what is important to your stakeholders as an organization? And then what are you doing to ensure that you have a very strong operational set of controls around that stakeholder alignment? And I think for me, the reporting and the communication and the disclosures are the, you know, that's the kind of the plumbing that you need to do on top of that. But if you haven't got that core basis of understanding of what's important to you as an organization and what's important to your stakeholders, then you're going to get in a pickle quite quickly. And I think the thing to watch out for is what I would call watermelons. And there's lots of watermelons out there. Boohoo was a watermelon. Boohoo looked like it was very green, but it, you know, they had people pissing in the bottles because they didn't provide an adequate worker rights in place. And I think there's lots of these examples where organizations are falling over themselves to look good on particular ESG measures, but actually be pretty glowing red in the middle. And, you know, as we all know, a watermelon is green only on the surface. You scratch the surface, it's yellow, very, very thin crust of yellow, and then the rest of it's red. And I think the danger is if people focus purely on reporting, purely on disclosures, and don't get the basics right, they're building a watermelon. And really, that's what we're trying to build ourselves to detect, is be better at detecting watermelons and publishing that data on our website.
I love the idea of detecting watermelons. I'm seeing all kinds of interesting graphics, Charles, there. So Karen, as you said, you know, risk takers and risk assessors, we don't really want to be underpricing watermelons, to take Charles's analogy, do we? But more broadly on the issues that you raised, that you can see from a change and process and controls perspective, what are the questions that are going around in your head at the moment, Karen?
Well, I think Charles made a very valid point, and when he used the word trust. So there's been lots and lots of talk in the insurance industry about whether we are a trusted voice or not. And I think his advice around looking internally first. So we're at the moment thinking about how we're going to price all of these other companies and what that means from a risk assessment perspective. We're not going to get those metrics because if we look at ourselves, we haven't got the metrics internally, right? So how are we going to be able to price or rate or do anything else on these firms? So we have to set the standard and we have to set the example. And I think there's a lot of learning that can be done from within firms around what ESG actually means. I also think we're doing a lot of it already, and I know that might sound a bit daft, but we're just not labelling it as ESG. So all the diversity and inclusion work that we've been doing over the last kind of 5 or 6 years, you know, where the gender pay gap, you know, kind of the women in finance, the work on BAME, we're doing a lot of the social pieces. We're looking at kind of social mobility of insurance. We are doing some interesting work in automation of processes. Now, actually, if we're automating processes, we are taking out some of the lower skilled work. Now, what does that mean from a ESG perspective? We're doing things like AI and screening of CVs. Charles mentioned this to us last time we had a conversation. You know, what does that AI mean for selection and the people within your organisations? You know, there's lots of activity that's going on. We're talking about parametric products and potentially algorithmic syndicates where you kind of take out the underwriter in the mix. You know, how does that impact society and kind of our end consumers? So I think there's been a lot of thinking going on, but I don't think we've labelled it ESG. And I think the first thing that we could do is turn it on our heads and do a deep dive of our organisation and say what initiatives, what practices are going on that fall into that ESG space, and are we comfortable with that in our organisation? Are we comfortable with kind of outsourcing our work to India where there's a higher carbon footprint? Does that fit with our ethos? Does that fit with our values? So I think that's probably the first thing that we should do, is actually make sure we've got our own houses in order and understand what that means. But I'm not saying we're starting from scratch. I'm saying there's some really good foundations, and we just need to bundle it all together as ESG and then work out how we move forward.
So when you say we should start there, I mean, when you think about the we, who are you thinking about? Are you seeing specific roles involved in that?
So I think as an organisation, everybody owns a part of this and everybody's got an interest in it. However, it's a risk element, so it's a risk angle. So is your CRO at the moment very, very prevalent in the risk space and talking about ESG? But it has to be top down and ground up. Everybody sitting on this Zoom call will have a feeling for what's important to them and what is their personal value with regard to ESG. They might be more interested in the social element, they might be more interested in the climate piece. We've all got our own personal values. Firms are going to have their corporate values, whether they've actively stated them or they're kind of hidden in their kind of annual reports. We need to get those two things aligned. And I think as actually people are looking at jobs and moving around in organisations, actually the corporate values are more important. And I can only say from my kind of Flood Re experience that a lot of people joined the organisation because they liked the social nature and the social aspirations of the organisation. Ultimately, that's what insurance is. It's protecting people or clients at the worst time of their lives. And actually, I think sometimes we forget that, and actually the linkage isn't always as clear as it could be. Okay,
thank you. So let's, we have about 10-15 minutes left just to give people on the call that heads up, but also our panelists as well. There's so much to talk about. I'd like to bring in a question first from one of our audience members. So let me read it to you. If technologies like Internet of Things and digital twins help provide carbon power usage data, for example, building by building, why aren't these being implemented and insurance products changed to drive this behavior? Well, I'm not sure we can answer that question, but Peter, do you have a view that you'd like to share?
Yeah, definitely. I think that's a really good question. I think that a lot of kind of traditional underwriting, Karen's just touched on, parametric insurance, there's a lot of evolution in this space. Some of it coming from outside the industry, quite a lot of it coming from, startups, insurtechs, as opposed to, the incumbent insurance space. But there is a lot of support and capacity being provided for those products. And that's also being encouraged by Lloyds. Lloyds are encouraging all managing agents to allocate 2% of their annual premiums towards innovative and sustainable product development by 2022. And they'll provide guidance on how to deliver on this ambition, because managing agents need to apply to use that 2% innovation capacity. It's not just given to you, it's not an automatic thing. And then that's how they'll then direct that capacity to away from this sort of away from traditional products into these non-traditional products. I think it's really important to note that perhaps in the Lloyds market, unlike the wider insurance space, there isn't necessarily a huge focus on research and development of new products. And that's why Lloyds are trying to enable this by using this innovation capacity.
Okay, so Martina and Charles, and the lure, the big carrot of having some extra capacity, if you can demonstrate that what you're doing as an insurer, as an insurance firm, is creating something new to meet new risks for customers in the ESG space broadly. What do you think, where do you think the greatest opportunities are that you can see? Thinking from your customer, I'm not expecting you to map it out for insurance because neither of you are insurance experts. That's why you're here. But what you see in terms of customers, the risks that are coming through at the moment for all sectors of the economy. And then maybe we can let our insurance colleagues, that's a to-do list for them to think about for new products and services for insurance. Martina, where are the biggest challenges that corporates are going to need help with addressing once they know how they already measure up from an ESG perspective? Your thoughts on that, please.
Sure. I think, the COVID context is showing us again that we are living in a very rapidly changing global world. And there, on the one hand, the opportunities and trends, we highlighted some of them, technology, which also lends itself, and AI to an investment theme, and quite successfully, as well as, of course, a business application and tool, or a whole set, an array of these. But then also the ever-changing role of business in society. We highlighted, and touched on the role of values and purpose, potentially also, of course, in this context, culture, and the ever-increasing change within the workforce of today and tomorrow. Millennials asking for these type of social activities, the type of employee engagement that we are increasingly seeing, the kind of the role of the business as a player within the community. But then, of course, we're also seeing, the downsides here. We're seeing the effects of climate change and the impact on biodiversity and the decrease in species, for instance, and extinction crisis, the next one actually looming, the next tragedy on the horizon looming. So ultimately, all of these upsides and downsides can have a significant impact on value creation and ultimately cost of capital, and potentially for the insurance sector, cost in relation to liabilities, litigation management, and ultimately, therefore, long-term liabilities management and insurance. But what's important in our sphere is to keep an eye on the type of macro trends, systemic risk and opportunities, and how these are being managed, and to maybe identify them in my area as investment themes, and clearly these type of challenges, themes, trends, and risks, some of them are systemic, others are ever changing and are in rotation. And reflecting this in the type of decisions you're making and how these decisions today can impact tomorrow is the biggest challenge in our time. You know, it's no longer like past performance is a predictor of the future. It's more like, where are we at in the present time? What are the lessons learned? What are the type of scenarios and pathways? And that's of course climate change, but also beyond, that we need to look at in order to make the right decisions and predictions and decisions for the future. And here again, the right type of data, more reliable data, as we discussed on the one hand, more data in real time with the indications of what is happening now and how can that be assessed, is becoming an absolute prerequisite.
So maybe spotting those watermelons as they're growing, Charles, is a bit inelegant. I don't think I can make your analogy work as well as you can. But to this point of where you think both the opportunities and the threats lie for insurance, the opportunities to create and visualize new ways of helping customer, Charles. But I guess also at this point, it'd be really good, I think, to get that your top line view of some of the really key considerations that we'll need to take into account with the recent EU proposed legislation on AI. So sorry, asking you to do two things there, if that's okay.
No problem at all. How long have you got? I think the thing to be on guard against, I mean, I'm certainly not going to argue against collecting more data or using more data in the day-to-day, but I would try and guard against something I call Datachauvinism, which is where you take data and you apply it in a very kind of single-minded way in order to innovate or build a new product. And I think we can see lots of examples of that going wrong. In the insurance context, I think it was only, a couple of months ago, we started seeing people in Texas in the US when they had extreme weather events, and they found that, you know, they were paying hundreds, if not thousands of dollars just for turning a kettle on, because they had an insurance product which was data driven and on the face of it looked great, on the face of it designed to save people money, and went very, very badly wrong very, very quickly for a lot of people. And I think, yeah, those are the sort of examples of kind of watermelon activity that I'm talking about. Things which on the surface look great, and when things, and I think particularly in the insurance industry where you're particularly looking at, you know, what's the propensity of something going wrong and modeling extreme events, you know, some of those examples are perhaps unforgivable. So I think to, you know, Elaine's question, you know, I think it's great to be able to look at risk at an asset level. It's great to be able to use technology like IoT or digital twin tech to start to model some of these things, but we've always got to have a keen eye on how can this be abused, how can this be misused, how can this go wrong. I think the EU regulations on AI go perhaps some way to guarding against some of the risks. And, you know, I guess what's great about those regulations, no one, I think in the Commission has used the term ESG in relation to those regulations, but, you know, I very much see them as a set of you know, reporting and disclosure standards that expand, you know, the thematic of ESG to encompass the use of AI. And, you know, Karen mentioned some CV screening. I mean, there's loads of examples of machine learning used in sort of day-to-day operations where, you know, organizations can carry risk. And so I think, you know, I think specifically around that, there's some very, very clear, easy wins which organizations can do, which is, first of all, build an inventory of their models, build an inventory of the algorithmic systems and also the non-algorithmic automation systems that they're deploying. Secondly, do a risk assessment of those. Thirdly, have some sort of quality management platform in place, to use the European language, or an ML ops platform, to use a more traditional data engineering language.
Is that machine learning? Was that machine learning,
so,
ML ops?
So,
yeah.
That was the acronym police in action there. So yeah, machine learning, machine learning. But I think these disciplines shouldn't be at all foreign to people in the insurance industry. And it's certainly what I see in, you know, I was at Fidelity before ethics grade, but I was originally on the sell side in capital markets. And so the idea of having model risk management and, you know, having an inventory of algorithmic models and looking at the risks of how they go wrong. I mean, these are disciplines which have been around for for certainly all of my career, if not longer. So I think those disciplines do exist. I'm sure they do exist in the insurance world. But I think when we see things go wrong, like the Texan energy problem from a few months ago, it's because those disciplines haven't been used in these new fields. And I guess that's the risk here. We can see large brands erode their trust and erode their credibility when they make these mistakes. And when we talk about data breaches, British Airways and Marriott hotels always come to mind. What we don't want to see is similar examples in the insurance community. And so I think the things to do there are making sure corporate governance is connected to innovation. You've got those operational controls in place. And you're managing your stakeholder expectations, and you have a very strong identity with those stakeholder expectations. I think if you can do those two things, then you've probably got the most important things covered.
Thank you, Charles. So Peter and Karen, inventories of algorithmic and non-algo but automated processes, think that's something that everybody on this call will know is going on in their organization. Peter, your facial expression is so eloquent. What do you think the answer to that question is?
Yeah, I think probably similarly to last time, we all got together and Charles mentioned AI and I had a little mini meltdown. I think, yeah, we're right, particularly in the specialty insurance market. As Karen said, we're doing a lot of this already. It might be labeled slightly differently. But I think we're also at this beginning of this journey of digitization, of algorithmic trading, which really is an opportunity to get it right from the beginning, I think.
I wasn't so much suggesting actually that you guys were behind the curve, because I don't think that's true at all.
Right.
I was asking the question much more about, Charles is referring to a series of well tried and tested. This is what everyone else we should have been doing for years. It's kind of that everyday basic. Karen, do you think it's an everyday basic that everyone's familiar with? It's slightly less sexy, isn't it, than thinking we've got to somehow change the world overnight from an ESG perspective, but it's a much more nitty gritty place to start.
And I think that's true. So what I don't think we're doing on the kind of the automation and the AI is necessarily giving all of the ESG factors enough prominence in that decision-making process. And ultimately, I mean, Charles has name dropped a couple of companies that I'm sure some of us have all done some shopping with. Are we necessarily aware of what they're doing and how they're doing it? So maybe some are and some aren't. But as time moves on, reputation in the ESG space is going to become more and more prominent. We as insurance industry are already saying we want to assess and manage and assess risk and probably price up or decline risks on the basis of ESG scores. So we'd be silly not to think about it internally properly now and do what we can to kind of mitigate that. That said, it's a really difficult issue. I mean, someone's just put on the chat that climate risk is one of the kind of biggest ESG boutique risks. Completely agree. It's very prominent. We're all aware of it. We know how it affects property and casualty. We're very, very clear. How do we fix it? What can we do about it? Who knows? There's lots of activity going on in the reinsurance space to do kind of analysis in that space. But actually, AM Best have actually said that corporate governance and cybersecurity are also another two trends in ESG that we as insurance companies should be very, very aware of and thinking about. And that's the whole point, is that we understand these risks. I think we're getting better at vocalizing them. What are we actually doing to mitigate those risks? And I think that's where the activity kind of needs to focus moving forward, is the doing or the doing something on the back of that information. And someone else has just put, how do you choose between ESG metrics and data? I mean, that's a really difficult one to do, and it's very much goes back to kind of values, goes back to what's important to your firm, how do you want to make decisions? And there isn't one answer, and I think because it is so interpretive at the moment, there's lots of people floating around the market offering ESG metrics on this and metrics on that. Where do you start? What's right? What's wrong? I think if you made a decision now, it would probably be the wrong decision. If you made a decision in 6 months, it would probably still be the wrong decision. But actually, you've got to start somewhere. So I'm not saying don't go out and buy data. I'm actually saying go out and think about what you might want. And be flexible, and this will change in the next 2 to 3 years as we all become more accomplished in this area.
Wow. Okay. well, we're coming to the end of this 45-minute session or so, people. So thank you so much. A lot to think about there. And thank you so much for joining us today. We have recorded the session, and it will be made available for later. We'll also be following up on some of the questions and also trying to go a little bit further in getting some more clarity on those next steps that Karen and Peter have both referred to. So panelists, thank you so much. I mean, it was an impossible task, really, wasn't it, to talk about ESG, even just focusing on data in 45 minutes. But thank you so much for joining us today. Martina, thank you. Charles, thank you. Peter, thank you. Karen, thank you. And thank you to all our audience. Thanks again for joining us. Hope to see you again soon. Take care.